Welcome back to Rockstock Channel and our second of 3 videos from Fastmarkets' flagship lithium and battery raw materials conference in Phoenix last week. In today's video, Rodney Hooper details why he thinks the battery-grade lithium will be in structural deficit as far as the eye can see, resulting in lithium prices remaining stronger for a lot longer than some investment banking analysts are forecasting. A couple of things I'd like to add since Rodney gave that presentation. I've observed that narratives in lithium tend to shift every 6 or 12 months or so, and that what's happening in China looks again to be the driving factor for lithium. Ganfeng Lithium in previous years has been a leading indicator of how ASX, TSX, and US listed lithium names will perform, up or down, sometimes 3 or 6 months in advance. Ganfeng has upticked a bit since the end of April, but is still down on a 1-year and a year-to-date basis. I suspect this is because it is still reliant to a large degree on purchasing spodumene at market prices and therefore has meaningfully lower margins than vertically integrated Albemarle, for example. I believe that Tianqi Lithium, another top 4 producer, has now taken on this leading indicator mantle. Like Albemarle, Tianqi is vertically integrated, and after 2 years in distress due to high debt taken to buy a stake in SQM for $4 billion, and also big cost overruns at its hydroxide plant in Australia, it is now recovering. High lithium prices are greatly helping, and it looks finally to be bringing on first hydroxide production at Kwinana in Western Australia. My June 30th lithium equity scoreboard was a sea of red, save for one standout, Tianqi, which has been rallying aggressively all year. Tianqi tried and failed in 2018 to raise $1 billion in a Hong Kong IPO. But this week, it managed to raise nearly twice that amount, $1.7 billion. And the deal was priced at 82 Hong Kong dollars, the top end of the $69 to $82 price range. This is a very bullish indicator, in my opinion, and could portend a rally in ex-China shares in coming months. Supporting this logic are a series of tweets Rodney put out in the past week, flagging potential record EV sales in China in June, and guidance from both BYD and Tesla that second half sales will be much higher than first half. Rodney also shared some thoughts about the European supply chain conundrum and Ford's recent offtake and financing deal with Liontown in an interview with the Assay magazine, published by the 121 conferences. I've put a link to this article in the video description if you'd like to check it out. Don't forget to subscribe to Rockstock Channel and click the notification bell if you haven't already done so.
So I'm going to address a question that's become really topical in the last while. And that question is whether the structural deficit is here to stay. So I'll outline firstly demand correctly, but the short answer to the question is yes. And to be very specific, the answer is yes for battery grade lithium. If we look, incumbents have no real working inventory left. So the net market balance is now specifically defined by current supply and demand, and then recycling coming into the mix. In our opinion, battery grade demand is cathode production and not battery sales. And cathode production looks forward by 6+ months. So the first half of 2022 cathode production is second half EV demand, and the second half of this year will be cathode production will be for 2023 first half EV demand. And this number is much greater than battery sales times some kind of consumption ratio that's an estimate of production scrappage, etc. And it also includes things like inventory builds and battery replacements. So if we think that EV sales grew 100% in 2021 and the consensus is, let's call it around 50% for 2022, that translates into a major demand difference when using the cathode production formula rather than some kind of a battery sales formula within that window. And then looking at framing supply correctly, there are no projects ahead of schedule. At best, they're running on schedule, and that's mostly brownfield. Greenfields will take longer, full stop. If we look at the percentage that greenfields represent of new supply, that's growing substantially, which means we've got an increased risk of delays. And if we look at unconventional flow sheets within those greenfield projects, they're a growing percentage as well. So we ask the question, can you include an unfunded, unpermitted project yet to start construction and future supply estimates? We say no. It is a binary thing. You need to get up and running first. And the other thing to also think about in terms of supply is incumbents need to build back inventories. So that is going to take away from what's available. And then we look at another issue plaguing the industry is if you look at the surge in demand, it's difficult for cathode manufacturers to qualify new material. And because of the high percentage of greenfield projects within new supply, the average market qualification timelines are definitely going to increase given the amount of greenfield projects. So if anything, battery grade qualified supply is going to be even more behind the curve than what we've seen when incumbents have dominated the industry. Just quickly looking at 2022 supply, I thought I was extremely conservative when I had Albemarle at a 30% up for the year. That's now the top of their given range. If you look at Pilbara and what they are expecting as an average quarterly production, they've got 90,000 tons. That's, if you look on the line here below, that's pretty flat. And then Allchem, you know, they had some previous sales, so they're out of inventory and production growth will take time to ramp. So how do we look at that compared to what we're seeing in demand at the moment? This was taken at the 16th of June. What are the average waiting times for a new EV? Is demand going to stay up? Well, most of the new waiting times now range between 6 months and 2 years. Well, why is that relevant? In 2020, the average wait time was 10 weeks, about 2.5 months. And we think that might be part of the reason why we're seeing delays and we're seeing total auto sales falling. It's possibly because people cannot buy EVs and have to sit and wait it out, and they're waiting for an EV. If you look at EV sales for 2022, depending on geographic sales mix, and that depends on really how many EVs are sold in China, we see EV sales capped at a sort of upper end of around 8.5 million given lithium supply, and that's well below the consensus forecast of 10 million plus. And if we look, provided the economics and carbon emission stats continue to heavily favor EVs, the banning of the sale of new ICE vehicles in major auto markets is likely to still be on track for being somewhere between 2030 and 2035. If a new production line for an ICE vehicle typically runs for 5 to 7 years, why would an OEM introduce a new ICE model after 2025 or 2030? And then you've got the fact that ongoing running costs of an EV are substantially below an internal combustion engine vehicle. So why would a consumer buy a new or a used ICE vehicle after 2030 unless it was heavily discounted and someone would have had to have taken that depreciation on board? We're seeing EV penetration is currently ahead of expectations. It makes sense that that trend continues given economics at the expense of ICE vehicles. So we don't, unless there is a prolonged recession. But even then, if you look at who economically buys EVs, we think that market will remain more robust than the general economic trend. So we think demand will stay firm. Looking at January to April 2022, global EV sales were impacted by China COVID lockdowns. In the first 4 months of this year, global EV sales were around 2.5 million, which means 7.5 million annualized. That's well below the consensus forecast of around 10 million. And cathode demand for year-end sales and post-COVID lockdowns are starting to emerge. So if we think about it, we've seen a very little tapering off in the battery grade lithium prices, even though we've had external forces impacting the sale of EVs, and that's something that should be flagging. It doesn't seem to have been recognized, and we think that's going to have an impact. The other indicator I'm sure that's come up is the Pilbara Minerals BMX auction. The latest sales done in this past week, setting a new record, adjusted to SC6 on a CIF basis, is $7,000 a ton versus the 6.3 on the actual trade. I've seen different numbers bandied about. As far as my equations go, if you use the $7,000 a ton and you add some conversion costs and you add VAT and a reasonable converter margin, nothing extreme, but certainly in the 10 to 15% level, that gives you a $75,000 a ton VAT inclusive price in China. And that would put us back somewhere in the region of highs, and we think it's possible we can go above that. So just looking ahead, and where I think some of the confusion comes in is if we look at aggregate net supply of lithium, even my models have a 37,000 oversupply for next year in 2023. But if you pass that down to battery grade supply, I have an undersupply of 70,000 tons next year, assuming 12.6 million EV sales is the number. And I think that's what everyone needs to focus on, because ultimately it is battery grade where the bulk of demand is going to be. And I think, again, that's where perhaps the misunderstanding is coming, is treating non-battery grade and battery grade as interchangeable and just lumped together, I think is something that shouldn't happen. If you look beyond 2023, I have the battery grade supply going over 100,000 tons in shortfall in 24 and growing. Of course, that can be impacted if we see immediate investment into future supply growth. But at the moment, that's something that also gets overlooked, it would seem, is how much has gone into upstream investment and how much of that is going to translate into battery grade supply. But as things stand, we see that chart steepening as battery grade undersupply widens. Why the difference between aggregate and battery grade? Again, battery grade demand is cathode production less recycled and qualified. It isn't battery grade, isn't battery sold or installed, times an adjustment factor, because it excludes too many factors and doesn't give you the full number. We think this difference may widen as new cell factories come online with higher initial production scrappage. So it could actually be even more amplified in the future. As I mentioned earlier, cathode production is 6+ months ahead of EV sales. So you can have a mismatch between what lithium demand is in 1 year and what EV sales are in that same year. The battery grade supply qualification is 6 months plus on brownfield and longer on greenfield, and greenfield are going to take longer. Unconventional and unproven flow sheets representing an increasing percentage, and those will face delays. The other thing is the reprocessing of non-battery grade material, which uses up some of the what looks notionally like available capacity. So you have a double counting, and that lowers what's actually being produced. And another thing to consider is these major issues exist before we factor in an increasing strictness on ESG carbon footprint and on logistics that we're facing, that the world's trying to come out of as we move out of COVID. So what is the conclusion that we draw? We believe that the battery grade lithium market has been in a supply demand structural deficit since late 2020. 2021 saw the drawdown of the last of inventories. So we believe just on a supply demand net off basis, we've been in structural deficit for some time. the temporary slowdown in EV sales in the first 4 months of 2022 hasn't caused a major correction in lithium prices. We believe if 2022 EV sales trend back towards the consensus forecast of 10 million units, which again, we don't think is possible. We think, if anything, lithium is going to test 500,000 renminbi a ton if we track back to 800,000 units a month of EV sales. And I think Pilbara's latest auction is a warning indicator of that. If we look at downstream capital invested in cathode, cell, and EV production, it's substantial. There is a lot of downstream capacity to absorb increased lithium production. So as long as EV demand remains solid, the downstream part of the system can absorb more lithium. And underlined, producers need to restock inventories. At the moment, they just haven't had a chance. How big should those get to? You can decide on your own numbers, but at least I would have thought, given logistical problems, 2 to 3 months. So how does one fix this? How do we get around this? We still think that spodumene to spare Chinese conversion capacity is the quickest route to increase supply. Look at the MinRes Albemarle example. We think the China brines are seasonal and lepidolite is challenging, so I don't know that that's going to be quite what it's made out to be. The other positive supply contributor could be late-stage conventional brines outside of China, and we think those will also continue to be favored. And given this, we think this is the year in which the market will finally realize that there is a problem, and next year it's not going to be raining excess supply. Anything that can produce before 2025 is going to be in high demand, in our opinion, and that might even widen as the shortage is fully understood. If you look, lithium is now the largest raw material cost in an NMC 622 cell. And we think that this is the year that OEMs and cell companies will be forced into major M&A JV upstream to secure, lithium supply. And this point has been made many times by many of my fellow commentators in the industry. You cannot just secure supply if prices are going to remain elevated because there's been insufficient upstream investment. You need to secure supply, and you need to lock in price at a reasonable level as well in order to make decent operating margins as an OEM. So in order to do that, there is no choice but to make closer investments and direct investments into upstream producers. We've seen Stellantis do something. I think there will be many more. As I say, an offtake isn't going to do it. If you're going to rely on a supposed oversupply, I think it's going to put a dent in operating margins. And given the recent pullback in the markets and the valuation of equities, and given where we are, in our opinion, this is a great opportunity. But we do believe that the structural deficit has been in existence on just a supply-demand basis, excluding inventory. Now that inventories is gone, we think it's very clear. We've had a fairly muted EV sales for the first 4 months of this year, and prices have barely nudged down. So as sales resume, we think prices are going to be under pressure on the upside again. So that's our view. Thanks very much for listening. I hope you've all enjoyed the conference.
What do you see as the risks to your views, for example, a recession impacting EV demand?
We're already entering into the early stages of a recession, and you've got a 6 to 24 month waiting list for an EV of the major models. So I guess an early indicator will be if those waiting lists drop, but at the moment they aren't. If you can get a Tesla or a VW or what have you in a week, then yeah, I think then there's a risk that demand has tapered off. But for now, you saw that it was June 16th, that number, and that's suggesting, if anything, the opposite. Thanks very much.